Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Hey, everybody. I am here today with Charlotte Lawrence. Charlotte is a senior at Middlebury, and I'll give you a second, Charlotte, to just introduce yourself, talk about maybe what you did last summer and what you have coming up for full-time.
Hi, yeah, so I'm Charlotte. I'm a senior at Middlebury in Vermont now. I'm majoring in international politics and economics. And going into my sophomore year, I found myself really interested in wanting to learn more about investment banking and wanting to pursue a career in that space. I ended up getting an internship at Goldman Sachs this past summer in New York. I was in their American financing group or their product group, specifically in investment grade capital markets, and I was in the tech media telecom pod. And post-graduation, I will be returning to Goldman, still in investment grade capital markets.
Awesome. And I think this is a great opportunity to just talk a little bit about the differences between financing group versus kind of the coverage group. And different banks have different names for it, whether it's coverage or classic or whatever. And then, the financing group, the product groups. Could you just talk a little bit about, what investment grade capital markets, for big words, like what that means, and then kind of how the financing group works?
Totally. So I think this is something that was a big obstacle for me when I was beginning recruiting, just, asking people what their role was. And then all of a sudden it was a lot of jargon that I didn't understand. So I think one way that I broke it down that was more helpful to me, essentially investment banks are divided between product and coverage groups, or at Goldman, they call them financing and classic. And essentially the coverage groups or the classic groups are kind of the traditional industry verticals that you hear about in investment banking. And so these are the larger teams that are working on all phases really of the deal process. And so they're going in depth with the modeling and the due diligence for, maybe months. And then at the point that one of these industry coverage groups has a client who actually wants to go through with the deal, they will then look to finance that deal. And that's where the product groups or the financing group at Goldman comes in. And so the different groups on the financing floor kind of represent the different types of capital that these corporations are using in these deals. And so I was in the investment grade capital markets group, which is called debt capital markets at most other banks. Some of the other examples of products groups would be equity capital markets, leverage finance, structured finance. And within debt capital markets specifically, what we were doing was working with highly credit rated corporations who needed to raise debt to fund whatever deal they were doing. Maybe they were acquiring another company and they didn't have enough cash on their balance sheet to pay for the valuation price of the company. And so they would then go to the debt capital markets and raise debt to pay off that acquisition. And so that's what I was doing most of the summer. I was working with corporations that were looking to bring deals to market that involved raising debt or refinancing the existing debt stacks of these corporations.
Awesome. Yeah. Thank you so much for that breakdown. And yeah, I guess I one way I think about it is if someone says that they work in investment banking and then they tell you a group that has a lot of words and it's not immediately clear what that means, it's almost definitely, a product group or it's in the financing group. And I love the way you broke it down, which is basically if you are a company and you're going to an investment bank for advice, you are very likely going to have kind of the classic or coverage team involved. If you are going to an investment bank seeking money or seeking to monetize something, then you're going to the relevant bucket of the financing group, which is to say, if you want, you're willing to give away equity for money, then you're going to the equity capital markets team. If you want to borrow some money, then if you are highly rated, then you will go to the investment grade team. If you are not so highly rated, then you will go to the leveraged finance team. That is not to say that if you're in a product group, you don't give any advice, because you're giving a lot of advice a lot of the time just about financing topics. So I don't know if you could give an example of maybe not like a deal that you worked on, but if there was like, don't tell me like the company name, but just like high level types of projects that you might work on, in IG.
Yeah, totally. So I think one thing that was really on the minds of a lot of the corporations that we worked with this summer was given how high rates were, it was really expensive for a lot of these companies to raise debt. And typically for these highly rated companies, they can usually acquire debt at not that much of an additional cost over whatever the US Treasury rate was. But this summer, that rate was really high. And so I think a lot of our corporations were for the first time trying to look for other solutions. And so we would kind of talk to them about maybe some hybrid options that were somewhere between debt and equity. And so they would be a little bit more accessible in terms of the price that it would cost for these clients to get debt. I think that was a big thing. Another big topic is foreign exchange. So a lot of these companies being really highly rated, a lot of times they're really big global corporations and will have sizable operations in maybe Europe or Asia. And so a lot of times, they would need to raise debt in those foreign currencies. And so we would talk to them about how best to do that. Sometimes it was also, good to work with the derivatives team. I might be getting a little into the weeds here, but basically we would kind of look at all the debt that they had and see like if there were any strategies we could work on in terms of, accessing foreign capital markets or swapping their debt to a foreign market or things like that. I think those were kind of some of the big considerations we had, as well as just looking at how much debt they had outstanding and seeing, can they raise a lot of debt that's coming due soon, or maybe they have a lot of debt coming due soon and maybe we should raise some debt with longer maturities and things like that.
Yeah, man, you mentioned another group which is worth talking about, because there's a liability management team, there's a corporate derivatives team, there's all of this stuff all living in the financing group. Because not only can you go to a financing group to learn about how to borrow money, or give away equity, but you might also go to the group if you are looking to manage your balance sheet in some particular way. So tell me a little bit about, when you hear people saying like raise debt in another currency. So maybe they're looking to do like euro denominated, debt issuance. Like why would anybody do that? Why does that matter?
Yeah, you're always trying to kind of look at your balance sheet and match what you have in your assets and your liabilities. And so, if you have a lot of, liabilities in Europe, where you would need, European money eventually to pay those off, it can be dangerous and kind of just expose you to sort of foreign currency risk and things like that if you only have assets in US currency, because then, in the event that you suddenly needed to pay something off or something like that, and you only had US currency and you suddenly had to get a ton of euros, that could be something that can be challenging for a company, especially in a world when exchange rates are always moving. So sometimes you might be able to get more dollars for €1 or vice versa than in other climates. And so we kind of try to work with our teams that look at those foreign exchange markets and understand, when might it be profitable for a company to actually just raise money in the European currency. It might be more, they might get kind of a benefit based on where that exchange rate is now. And the goal is always just to be matching your assets and your liabilities. We also do that in terms of fixed and floating rate debt. And so our derivatives team that I mentioned before that does a lot of these kind of foreign exchange considerations, they also look at floating rates versus fixed rate. And that's basically just the way that the debt is priced. Either it's a fixed rate where it will be priced when it comes to market, or it can be priced above a floating rate, which is kind of a internationally established rate that fluctuates based on where markets are. And so you want to kind of make sure that you have a good mix of your floating and fixed rate as well, just in case rates suddenly really move. You don't want the value of all of your debt to suddenly be, really undercut.
You touched on something that I found one of the most fascinating parts of that job as someone who also, I think regular listeners know that I started my career in investment grade. So I know it's been a while, but I know a little bit about this stuff at least. But just the kind of creative thinking that goes into looking at a company, trying to understand all of the things they have going on. And you're talking about, asset liability matching on the balance sheet. Like a perfect example of this is you might think that any big multinational company reports in dollars. And so you can, raise money in dollars. But if you have a big European business that produces profits in euros, and all of a sudden the FX rate totally goes, against them in some material way, they might end up having a lot fewer dollars of profit from that business that, now they are less able potentially to make interest payments. So a lot of that asset liability matching, very fascinating, very interesting part of the job. And in a lot of ways, you're sometimes informing clients about some of this stuff. I want to talk about bond math, and because you're talking about fixed and floating rate notes
Oh gosh.
for your interviews, how did you do any bond math prep? Like what like how were your interview questions? Like what were they like?
Yeah, so I think it's hard in some ways to prepare for interviews technically because at least for me, I had, a broadly financing group interview, but I didn't know I wasn't applying for investment grade capital markets specifically. So I remember in kind of the months that led up, I was on the phone with people who worked in equity capital markets, kind of trying to understand what they did and what they looked at. And then I was on the phone with people in IG talking about bond math. And I think sometimes you're kind of going a mile wide and inch deep in terms of trying to prepare. But I remember I did have analysts who I kind of talked with in that process who worked in IG. And so we did a lot of bond math in my kind of like mock interviews. I think this is something that took me a really long time to wrap my head around before working on the job. You kind of, it's price goes up, yield goes down is kind of the relationship, but it's hard to conceptualize, I think, until you're really looking at it. And so, yeah, I will say I did a lot of bond math prep. That was something I really focused on because I think it was one of the technical areas that was hardest for me to kind of be able to answer questions on. In my actual interview, I had no bond math. Like I said, it was a financing group kind of broadly interview. I think I talked most actually about the markets. And so I think a big piece of advice I'd give to anyone who wants to interview for a product role or a financing role is follow the markets, not just for a week, but like for months up before interviews so that you're kind of able to say like, what are corporations looking at, what are investors looking at, what are investment banks looking at, and kind of have an opinion about where you think things are going to go. I think that was biggest for me. But I didn't actually get any bond math questions, which I think was probably fortunate for me at the time.
Yes, I remember that I memorized the forward phrase investment grade capital markets. I probably did a little bit of bond math prep. I'm pretty sure that I did. And then a whole lot of other technical prep that I ended up not using. This
Yeah.
markets thing is huge. So, and I got that same piece of advice. And when I got that piece of advice, I was like, okay, I only 30% understand what each of those words mean and like what the phrase means. So let's unpack that. So following the markets, what is that? One, what does that mean to you? And two, what are good resources out there if I was someone who wanted to follow the markets?
Yes. So I think this was totally something that, someone told me when I was a sophomore, you need to follow the markets. And I was like, I have no idea how to do that. I think it can be hard to, similarly as we talked about before with the jargon, just in terms of being like, oh, I'm in the TMT pod of the IGCM group and AFG at Goldman. Like it can be really hard when you first start out because there's so many kind of terms that you just don't understand. And so I think when I first kind of opened like the Morning Brew or something and was trying to read a report and was seeing like, equities jumped in XYZ commodities, I was like, I have no idea what's going on. But I think what really helped me was kind of someone just saying, what they want you to understand is like, what are the big themes that are going on and how is that impacting like what actors are doing? So how is that impacting, a company who wants to work with an investment bank to go to the debt market? Like, what are they looking at right now that might be informing like whether or not they're actually going to the market? And so the thing that I thought helped the most was Bloomberg has a lot of email newsletters. My favorite was Bloomberg's 5 things you need to know to start your day. I tell everyone at Middlebury who asks me questions this. And the reason I liked this one is because it kind of has like 5 paragraphs or something like that usually, and it just hits on the big themes. So I remember when I was recruiting, they were talking about the yield curve inverting and the Fed hiking rates and where they thought rates might go. And then, Russia had invaded Ukraine, so they were talking about the impacts on commodity prices. And there's probably one other thing, but I think like those were kind of the bigger themes. Whereas I think where I got lost following the markets in quotes sometimes was, looking at like, oh, tech stocks are jumping today or things like that, where that is relevant, especially if you're going into like a trading role. But when you're in banking and you're really kind of just looking at the broader themes, I thought that newsletter was a really good resource. And I think, Googling things honestly goes a long way if you're reading a Wall Street Journal article or maybe listening to a podcast. There were a lot of podcasts people liked. I wasn't a big podcast person, so I probably don't have as many to recommend, but I'm actually Goldman Sachs Exchanges is pretty good. They'll talk about some stuff going on. But just look stuff up when you don't understand it. And then next time you hear it, or read it in an article, you'll be able to contextualize it and understand what it means. So another thing would just do it over time. So if you read about trends for a couple days, you're not going to have a great picture of what's going on. But if you, over a period of months, you'll kind of be able to see, okay, this is where rates are moving. Like this is what the Fed is doing. This is what investors are guessing will happen, things like that.
I love that answer. So 5 things you should know today on Bloomberg, and it's free to sign up for, I believe.
Yeah, I'm pretty sure it's free.
Yeah. Great. And then I think also like Wall Street Journal subscription through your school, you likely can get access to it for free. So that's something else I'd recommend. And then for international news, I think the Financial Times is another great resource. Might not get that for free through school. So prioritize Wall Street Journal if you can only do one of those. I want to talk about another thing that you touched on, which is having a view. And so you're reading all these markets, you're like, okay, like I guess that's interesting. What is like a threshold for having a view? Like, what does that mean to you? Because I remember that when people said like learn the technicals or like have a view, I remember not even knowing what the bar for like having a view meant was, like every time I tried to say something, I was like, is this stupid? Like, are people going to laugh at me if I say this is my opinion?
Yeah, I think the great thing about markets actually is that people have different views all the time. And so it's not necessarily like there's only one right answer kind of question. I think it's really more like, have you done research? And then have you been able to kind of like contextualize what your research means and understand it in a way that shows you kind of understand like how markets tend to work, like how things tend to impact markets and just a view that you can articulate and back up, I think really makes sense. And I think like why they just want you to be able to show that you have like A, intellectual curiosity, and B, then are able to like take the information that you learn and like put it together in sort of like a critical thinking type of way. And so I think like my year, what I really focused on was just, I would kind of say like, I do think the Fed is going to keep hiking rates this amount of times. Like this is why. And that's something where if you were looking up Wall Street Journal articles, they'll probably have a view and they'll probably explain why. So you don't necessarily need to reinvent the wheel. But if you're able to kind of read it in a way where you're like, okay, I'm not just regurgitating, like we think the Fed will raise rates. But if you're able to say, right now, because of supply chain pressures and other reasons, prices are really high post-COVID, and the unemployment market is really tight. And so the US economy is really running kind of overheated. And because of that, the Fed is going to need to do something contractionary. And so because of that, they're going to need to hike interest rates further, because right now where the US economy is running is not sustainable. And so I do believe that the Fed is going to hike rates. Like if you're able to kind of articulate reasoning and why they would do something, I think you don't need to worry so much about whether or not you're right, but just whether or not you are able to back it up with something that makes sense and kind of shows some understanding of broader dynamics.
Awesome. Wonderful example. Yeah. Thank you for giving listeners that. I just think that context is so helpful. And then one other thing I want to talk about, which is important to all capital markets, everything, is the Fed. And besides my quick plug here for if you want to know about what the Fed does and why it matters, I have a whole episode called What Does the Fed Do? But let's say you wanted to go beyond that and you wanted to try to learn about the Fed and Fed policy to a level of depth that you would need for these interviews. What are some resources you'd recommend? Is it just take an intro macro class in your econ department?
Yeah, I will say like somebody told me I'd taken intro macro and somebody had said, take macro theory. It'll tell you everything you need to know for interviews. And I was like very skeptical, not really understanding even because at that point I was like, no, I need to walk people through DCF. Like how is macro theory going to help? But it really does. I think it's nice to take an econ class. They will kind of go over in a very theoretical way, like why does the Federal Reserve exist? What is monetary policy? Like what are they intended to do? What are kind of tools that they have in their toolkit? And so then you'll kind of understand, okay, like I'm seeing them using one of these tools, which is raising rates. Like why? What is that when you're then reading articles? But if you don't have the opportunity to take a class, I think like there's a lot of resources out there, even just reading on the Fed's website, Fed meeting minutes, or going on to Investopedia or kind of similar resources. You can kind of Google, what is it? Google some of the history. Like the 1970s history is something I think someone once asked me about in a mock interview, which was another time that the Fed was very active in kind of the US economy. And so look up kind of the history, like why they were established. And I think once you kind of understand what the point of the body is, it's a lot easier to contextualize current news articles.
Awesome.
But I would plug macro. I think that did help a lot.
And then last question, just like if you think back to, yourself 2 years ago or 3 years ago, is there any advice you'd give yourself or anything that you're particularly glad that you stumbled upon or wish you could have known sooner?
Yeah, totally. I mean, I think that Bloomberg's newsletter honestly is kind of a big thing just because that really was like one resource I relied upon a lot that helped me. I think the biggest thing to remember, especially if you're coming from a liberal arts school like Middlebury, is that I think the relationships that you're able to build in terms of the recruiting process are really the most critical. Once you get on the job, you have to relearn everything. I can kind of attest to that, but I think what you can't learn is like the ability to establish a professional relationship where someone's able to kind of support you and guide you and vouch for you in an interview setting. Similarly, just the ability to kind of communicate and send an email. Like I think all of that is really critical. And so I think I would encourage like my former self to, definitely do the technicals, do the interview prep, but really what matters is seeking out people who can serve as mentors to you and serve as advocates for you. And, don't view networking like ticking a box, but really like try to come at every question or every conversation very genuinely and just try to use them to the best that you can where you are learning a lot. So I think that's important. And the other thing is just always stay organized. Like I think it's easy to let recruiting become overwhelming or become like a big part of your sophomore year. And I think it's important to make sure that you're, still doing other things and kind of keeping perspective while you do it. And so I think that staying really organized and really on top of what you're doing, even pushing yourself to be maybe more organized and make spreadsheets and Google calendars and things like that will really help you out a lot. But I think that that's probably some of the best advice that I got.
Awesome. Charlotte, thank you so much for coming on, for sharing your wisdom and expertise, and good luck with everything as you start full-time next year.
Thank you. I appreciate it. Thanks so much for having me.
That does it for today's episode. Thank you so much for listening. And remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.